Most new futures traders use time-based charts and hold positions overnight, thinking this is standard approach. Wrong. Professional futures day traders use tick charts and close all positions before market close, avoiding overnight margin requirements. Intraday margins are 1/10 of overnight margins. But 90% of retail traders don't understand this difference and get margin calls holding positions 5 minutes past close. Here's how to use futures day trading correctly and why E-mini S&P setup requires completely different approach than stock trading or options trading. Futures day trading exploits leverage and liquidity unavailable in other markets. E-mini S&P 500 futures contract controls 50 times S&P index value. Index at 5,000 means contract controls $250,000 of exposure. Intraday margin requirement is approximately 12,000. You control 250,000 with 12,000 capital. 20-to-1. Leverage. 1-point move in index equals $50 profit or loss. 4-point move equals $200. Volatility during regular session averages 30 to 50 points. That's $1,500 to $2,500 daily range on single contract. Professional traders capture fraction of this range repeatedly throughout session. Understanding E-mini S&P contract specifications is fundamental to any profitable trading. Full name is E-mini S&P 500 futures. Ticker symbol ES, trades on CME Globex electronic platform. Contract multiplier is $50 per point. Minimum tick is 0.25 points equals $12.50. Regular trading hours 9:30 a.m. to 4 p.m. Eastern. Extended hours nearly 24 hours. Most volume and volatility occurs regular session. Contract months are March, June, September, December. Front month is most liquid. Roll to next contract month week before expiration. Most day traders use front month exclusively. Tick charts versus time-based charts changes trading execution completely. Time-based chart shows new candle every fixed interval. 5-minute chart, 15-minute chart. New candle appears every interval regardless of trading activity. Slow periods produce candles with minimal price movement. Fast periods produce candles with massive ranges. This creates inconsistent analysis. Tick chart shows new candle every fixed number of trades. 500 tick chart, 1000 tick chart. New candle appears after exact number of transactions. During high volume periods, candles form quickly. During low volume, candles form slowly. This normalizes price action based on actual activity, not arbitrary time intervals. Most professional futures traders use tick charts because they reveal true market momentum. E-mini S&P typical tick chart settings are 500 tick for scalping, 1000 tick for day trading, 2000 tick for swing trading intraday. 500 tick chart on volatile day might produce 3 candles per minute. Same chart during lunch might produce 1 candle every 5 minutes. Chart adapts to market activity automatically. Time-based charts miss this. 5-minute chart looks identical whether market traded 10,000 contracts or 100 contracts that interval. Tick chart shows the difference clearly. Intraday margin versus overnight margin is critical difference most beginners miss. CME sets intraday margin around 12,000 per E-mini S&P contract. This applies if you close all positions before 4 p.m. Eastern regular session close. Hold any position past 4 p.m. and overnight margin applies. Overnight margin is approximately 115,000 per contract, 10 times higher. If you have 20,000 account and hold 2 contracts past close, you're immediately in margin call. Broker liquidates your position. You get closed out at terrible prices, lose substantial capital, all because you didn't close before. Session end. The margin reset happens exactly at 4 p.m. Eastern, not 4:01, 4 p.m. sharp. You have position at 3:59 and 59 seconds. Fine. Position exists 4 p.m. and 1 second. Margin call. Most platforms show countdown timer to session close. Professional day traders close all positions by 3:55 p.m., giving 5-minute buffer, never cutting it close. Beginners hold thinking they'll close 3:59. Get distracted, miss deadline. Broker force liquidates, devastating losses. Position sizing must account for leverage and volatility. E-mini S&P moves 30 to 50 points daily. $50 per point means $1,500 to $2,500 daily range per contract. Account with 25,000 should trade maximum 2 contracts, 1 contract preferred. This gives adequate buffer for normal intraday volatility without risking account blowup. Most beginners see 12,000 margin requirement and think they can trade 10 contracts with 120,000 buying power. Completely wrong. One bad trade and account is destroyed. Position sizing based on margin requirement is suicide. Position sizing must be based on dollar risk per point and average daily range. Stop loss placement requires understanding E-mini volatility. Average true range on E-mini S&P is approximately 30 points daily. Intraday trades need stops accounting for noise. 2 to 4 point stops are typical for scalping. 4 to 8 point stops for day trading. Stops tighter than 2 points get hit by normal bid-ask bounce. Stops wider than 10 points defeat purpose of day trading tight ranges. Most beginners use stops way too tight or way too wide. Too tight stops mean getting stopped out constantly on normal volatility. Too wide stops mean single losing trade destroys substantial account percentage. Common mistakes destroy futures day traders completely. First mistake is holding positions overnight accidentally. Trader has busy afternoon, forgets about open position, 4 p.m. passes. Overnight margin applies. Margin call, position liquidated, loses thousands. Set alerts for 3:50 p.m. daily. Never rely on memory. Second mistake is trading during low volume periods. Futures trade nearly 24 hours. Beginners trade 3 a.m. thinking they'll catch moves. Volume is dead. Spreads are wide. Slippage is massive. Only trade regular session 9:30 to 4 p.m. when volume and liquidity are optimal. Third mistake is using time-based charts like stocks. Stocks work fine on time-based because stock trading is appointment-based around news and earnings. Futures are continuous flow. Tick charts are superior. Fourth mistake is over-leveraging immediately. Beginner opens account with 25,000, sees 12,000 margin, trades 2 contracts, has lucky day, makes 800. Next day trades 4 contracts, thinking doubling position doubles profit, has bad day, loses 3,200. Down net 2,400 in 2 days. Over-leveraging during winning streak is fastest path to account destruction. Fifth mistake is ignoring major economic releases. Federal Reserve announcements, non-farm payroll, CPI releases cause massive volatility spikes. E-mini S&P can move 10 to 20 points in seconds. Beginners get caught in these moves. Stops get blown through. Slippage is enormous. Either avoid trading 30 minutes before and after major releases or trade much smaller size with wider stops. Never treat major release days like normal trading days. Real testing over 6-month period shows actual results. Experienced day trader trades E-mini S&P exclusively, uses 1,000 tick charts, trades 2 contracts, account size 60,000, average 15 trades daily, average profit per trade $87.50, average loss per trade $112.50, win rate 58%, daily gross profit approximately $500 average, trading costs including commissions and platform fees approximately $150 daily, net profit $350 daily. Over 125 trading days nets, 43,750, 73% return on 60,000 account. This represents upper tier performance. Typical retail trader loses money first year. Platform requirements for futures trading include CME data, feed costs, approximately 100 to 150 monthly. Professional charting software like Sierra Chart TradingView, NinjaTrader. Broker with low commissions and fast execution. TD Ameritrade Trade Station. Interactive brokers all offer futures. Commissions range from $1 to $2.50 per contract round turn. High-frequency traders need sub-$1 commissions. These costs add up. 15 trades daily at $2 per round turn is $600 monthly. Factor platform costs and data feeds. Total trading infrastructure runs $1,000 to $1,500 monthly. Need consistent profitability covering these costs before showing actual profit. Tax treatment is 60-40 rule for futures. 60% of gains taxed as long-term capital gains 15 or 20% rate. 40% taxed as short-term ordinary income rate, regardless of actual hold period. Day trading futures means every trade gets 60-40 treatment. Stock day trading means everything is short-term ordinary income. Substantial tax savings for profitable futures traders. File Form 6781, reporting futures gains and losses. Mark-to-market accounting is default for futures. All open positions treated as closed December 31st for tax purposes, reopened January 1st. This creates tax complications, but overall treatment is favorable versus stocks. The verdict: futures day trading offers professional leverage and tax treatment for disciplined traders with adequate capital and proper education. E-mini S&P provides optimal liquidity and tight spreads. Tick charts reveal true market momentum better than time-based charts. Intraday margins allow efficient capital use, but require closing positions before 4 p.m., avoiding overnight margin requirements. For experienced traders with 60,000 plus capital, this is viable full-time trading approach. For beginners with small accounts, this is extremely dangerous. Most retail futures traders lose money. Statistics show 90% failure rate within first year. Success requires education, discipline, adequate capital, proper risk management. Subscribe for futures day trading strategy. Stop using time-based charts and holding overnight positions. Start using tick charts and closing all positions before session end.